Hello and welcome. Today, with some expert help from our friends at My Tax Accountant, we're going to tackle the often confusing world of UK inheritance tax. We're going to break down all the key allowances for the 2026/27 tax year. What are the core rules, and what are some of the massive changes coming up that you absolutely need to have on your radar? Let's dive in.
Okay, just imagine this for a second. Your family is going through the toughest time imaginable, and then, out of nowhere, they get hit with a surprise tax bill for 6 figures. It's a total financial nightmare right on top of an emotional one. And that's exactly why understanding inheritance tax isn't just about spreadsheets and numbers. It's about protecting the people you care about the most.
So, here's what we're going to cover. We'll kick things off with the absolute basics, your core allowances. Then, we'll see how couples can potentially double them up. We're also going to uncover a bit of a trap for larger estates, look at some special reliefs, and then we'll tackle a huge change that's coming for pensions before we wrap it all up. All right, let's get right into the fundamentals. Every single person in the UK has 2 main allowances when it comes to inheritance tax. You can think of these as the essential building blocks for any kind of estate plan. So first up is what's called the nil rate band, or you'll hear it called the NRB. The easiest way to think of this is as your main tax-free allowance. It's the chunk of your estate, and this covers everything, cash, property, investments, the lot, that can be passed on completely 100% free of inheritance tax.
And that magic number is £325,000. But, and this is really the key detail, that number has not changed one bit since 2009. It's basically been frozen in time, and it's set to stay that way until at least 2031. With house prices and other assets climbing, this freeze means a lot more families are getting caught in the inheritance tax net than ever before.
Okay, so on top of the NRB, the government also brought in another allowance, mainly to help out with soaring property prices. This one is called the Residence Nil Rate Band, or RNRB. Now, it's a really valuable extra, but like the name suggests, it's specifically for your main home, and it comes with some very important strings attached.
This adds an extra £175,000 to your pot. So, in theory, that pushes your total tax-free allowance up to a nice round £500,000. But, and believe me, this is a big but, you have to play by some very specific rules to get it.
Right, so here's the catch. The RNRB is not for everyone. To qualify, the property had to have been your main home at some point, and it absolutely must be inherited by your direct descendants. We're talking children, which includes stepchildren and adopted children, or your grandchildren. It does not apply if you leave your home to your brothers, sisters, or your nieces and nephews. So let's put all that together. When you combine the 2 allowances, you can really see the potential. A single person who ticks all the right boxes can pass on a total of £500,000 completely tax-free. That's your £325,000 basic allowance, plus that extra £175,000 for your property.
Okay, now this is where things get really interesting, and frankly, quite powerful. For married couples and civil partners, these allowances aren't just for you as an individual, they can actually be combined. And this is where the potential for tax savings can literally double.
So you've got a single person with that potential £500,000 allowance, but spouses and civil partners have a massive advantage. Here's how it works. Any part of the nil rate band or the residence nil rate band that isn't used when the first partner passes away can be transferred and then claimed by the estate of the surviving partner. And this leads us to that headline-grabbing figure, £1 million. Yep, through this transferability, a married couple can potentially pass on a combined estate of up to £1 million, completely free of inheritance tax. That's 2 lots of £325,000 and 2 lots of £175,000, all bundled together. But, and please listen to this, here is a crucial warning. This transfer does not happen automatically. It's a huge misunderstanding that a lot of people have. The people who are managing the second estate, the executors, have to actively make a claim to HMRC for those extra allowances. Forgetting to do this is an incredibly costly mistake. Okay, so just as there is a huge benefit for couples, there's also a critical rule that can snatch away one of those key allowances. This is known as the taper rule, and it's basically a trap that's specifically designed for higher value estates. The number you need to watch out for here is £2 million. Now, this rule only affects the residence nil rate band, not your standard one. If the net value of the entire estate, that's the value before any other reliefs are taken off, goes over 2 million quid, the taper kicks in. So how does it work? Well, the math is actually pretty simple, but the effect can be brutal.
For every £2 the estate's value is over that £2 million mark, you lose £1 of your residence nil rate band. This can seriously shrink that allowance, or in some cases, wipe it out completely.
And you can see it really clearly in this table. For a single person's estate that's worth £2.1 million, you lose £50,000 of the RNRB straight away. At £2.2 million, you lose £100,000 of it. And you can see that by the time you get to an estate value of £2.35 million, the entire £175,000 residence nil rate band has just vanished. It's gone.
All right, let's switch gears and talk about another massive reform. This one's for owners of farms and businesses. From April 2026, the rules for two of the most generous tax reliefs in the whole system have been completely changed. So before this date, you had things called agricultural property relief and business property relief, and they could give you unlimited 100% relief from inheritance tax. This meant that entire farms or businesses could often be passed on completely tax-free. Well, from April 2026, that era of unlimited relief is over. It's been replaced by a new capped system. And this is the new cap. An individual can claim 100% relief on the first £2.5 million of their qualifying agricultural and business assets. But for any value above that cap, the relief gets slashed to just 50%. On a 40% tax, that basically creates an effective tax rate of 20% on everything over the limit. Now, the good news is that just like the other allowances we talked about, this new $2.5 million cap is also transferable between spouses and civil partners. And that means a married couple can protect up to a combined £5 million of their qualifying assets at that full 100% relief rate. And finally, we need to look ahead at what is honestly another seismic shift coming down the tracks. This one is all about pensions, which up until now have been one of the most tax-efficient things you can own from an inheritance tax point of view. You really need to pay close attention to this timeline because this is a monumental change. Right now, most pension pots are a fantastic estate planning tool because they sit completely outside of your estate for inheritance tax. But from April 2027, all of that changes. Unused pension funds will be dragged into your estate and will become fully subject to inheritance tax. This is a complete game changer. And this leads us to another absolutely critical professional tip. If you have been thinking of your pension as a way to pass on wealth to the next generation, this new change makes it totally essential that you review your entire estate plan, and especially who you've nominated as your beneficiaries as soon as you possibly can.
Phew, we have covered a lot of ground, haven't we? From the core allowances all the way to these huge new reforms. So let's just quickly summarize the key numbers you need to remember for the 2026/27 tax year.
Think of this table as your ultimate cheat sheet. It lays out the nil rate bands, the residence nil rate bands, and those total potential tax-free amounts for both an individual and a couple. And it also flags up that crucial $2 million taper threshold and the new $2.5 million cap for business and farm relief. Now, we have to say it's really important to remember that this has been a guide to the general rules. Tax law is famously complicated and everybody's personal situation is unique, so you should always get professional advice that's tailored specifically to you. Honestly, trying to navigate all these rules, especially with the huge changes on the way, can feel pretty overwhelming. But you don't have to do it alone. If you need expert help with planning your estate, understanding what tax you might face, or you just want some strategic advice, the team at My Tax Accountant is there for a consultation. And for more clear, practical tax explainers just like this one, all based on expert insights, make sure you subscribe to the My Tax Accountant channel. Thanks so much for watching.